Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today from his usual perch in Dubai, we've got Salih Yilmaz calling in, swinging a little bit further west. We've got Patricio Alvarez joining from his new location in Madrid, looking great. Glad you got the Bloomberg vest on. And then coming across the pond, we've got Talon Custer joining us from his undisclosed location in the New Jersey, New York City metro area. I'm in Atlanta, by the way, today. So thank you for joining. I think we're going to kick off today with a very interesting new piece of research from BI. That's our energy survey. We run these 2 to 3 times a year. Salih, who's on the call, is always our point person on doing that. And it's where we ask you what you think about the future of energy markets could look like. So Salih, give us a breakdown. What are some of the key highlights and themes from the survey this year?
Sure, thanks, Rob. And first of all, thank you to everyone who participated in the survey. We really appreciate it. This is a survey that we ran for 2 weeks in February, and this time we had almost 150 participants. And it was a relatively long one. I'll try to keep this as brief as possible. And this is all of the results are published now on the terminal. If you can't find it, you can reach out to any one of us, and we'll direct you to the report so that you can see all the results in detail. But generally, what we saw from the results is an upbeat outlook about oil prices, oil demand, OPEC plus unity. Not so upbeat for the EV and the energy transition outlook. So the way I've divided the questions in this instance was into 4. One was around oil prices. I mean, one question we asked was where oil prices might be at the end of this year, specifically Brent price at the end of this year. And the majority thought that we will be between $80 to $90 a barrel, which is in line with our core scenario and analyst expectations. We asked about the geopolitical risk premium that is currently being attached by the market onto prices, and a big majority said that there is less than $5 a barrel of risk premium attached to prices. And then I thought this was quite interesting. We asked what may be the key driver of oil prices in the next 2 years. And actually a majority of respondents said it's going to be OPEC plus policy that will be the key driver of oil prices. And it was actually the least number of respondents that picked geopolitical developments. I mean, this is one thing that arguably has been the biggest driver, at least since October 7 last year. But our respondents seem to think, more of our respondents seem to think that it will be other things in the order of OPEC plus policy. And then quite a few people selected China demand story, the non-OPEC plus supply growth, and Fed interest rate outlook. On to OPEC plus, some of the OPEC plus questions that we asked. Will the alliance remain in 2025? The answer was yes. Will they have to keep supply management forever? The majority said only from time to time they will have to keep supply management on. Will they have to switch their strategy from the current strategy of supporting prices back to focusing on market share? The answer was no. And we asked if there would be any more exits from the group this year, and this was quite uncertain. It was essentially 50-50 between our respondents. I'll move on to some of the supply and demand drivers, the third segment of questions that we asked. We asked when oil demand will peak, and the answer was essentially not anytime soon. And it's been interesting to see the shift in sentiment in this, because I think just a couple of years ago when we surveyed our clients, a bigger portion of the respondents were saying it might actually peak before 2030. Now the majority thinks it's going to be after 2030. We asked if the US output growth, whether the US output growth will impress again in 2024. The answer was no. The majority actually expects US production growth to be less than 500,000 barrels per day this year. Will Saudi Arabia reverse its decision that it announced that it will halt the oil expansion, oil capacity expansion? The majority said no, they will not reverse that decision. And we asked whether stricter US sanctions, potential stricter US sanctions, will reduce Russian crude exports in 2024. And the answer was no. And I know I've already talked for way too long, but finally, the group of questions we asked around EVs and the energy transition, we found out is that the era of oil is essentially not yet over, even as EVs are gaining traction. First question we asked was, will your next car be an EV? Majority said just not next car. 30% said yes, it will be an EV. More than 10% actually said never, they will never buy an EV. The second question on EVs was, when will EVs become 50% of global new car sales? And actually about half think EVs will not become 50% of global new car sales before 2030. And finally, we asked when EU majors will hit 50% green capex. And I think the interesting thing here was that 40% said they never will. And when we compare this to the results that we saw in our 2022 survey, it's gone up from 15% that said European majors will hit 50% green capex. 15% said never, and now 40% said this will never happen. So with that, I'll hand it back over to you.
Thank you, Salih. I know this is just a personal view, but I love my Tesla. I wouldn't characterize it as, you know, being. I don't really care about the drivetrain so much, but the self-driving, incredible. Taken a lot of road trips and drove up to Atlanta, and the car drove me here. It's great. It's really cool. So I don't know. That kind of tech is going to maybe entice people to change cars eventually, and maybe more of them will be, electric drivetrains. But I like the energy transition angle that you ended on, and I think that's a really great place to pick up and bring Talon on. So Talon, you look after a number of things for us, including the midstream segment of the energy business, as well as some of the key LNG export names in the US. And I know that for a lot of the companies, when they think about energy transition, you know, that doesn't always mean wind, solar, or electric vehicles per se. Gas is the sort of low carbon cousin of a number of the other fossil fuels, and I think it's a key piece of the story. So give us a sense of where gas is at in that sort of global energy transition story. And specifically, one question that comes to my mind is kind of, what's that medium term growth trajectory for LNG demand looking like these days?
Yeah, I mean, I still believe that gas and LNG is going to play a role for decades to come. Medium-term growth outlook, it's hard to say exactly. I mean, I can say the US LNG supply, I know we have that growing at an 11% CAGR through 2029, right? So that's demand's not going to grow that much, but I think, low to mid single digits annually over the next, let's call it through 2030, I think is reasonable. Increasingly you hear an argument about concerns of stranded assets, and I'm sure Pat has opinions on this, and in Europe and the direction that region is specifically going with gas. But when you think about it globally, there's just still so many developing nations. And, I think we should still invest in, the renewables. We need wind, solar, and look for other options. I don't know if hydrogen is the answer, but there's renewable natural gas. Nuclear would hopefully play a bigger role. But you think about gas, and I think that the single most in the near term, the lowest hanging fruit to improve carbon emissions is to get China and India specifically to switch from coal to gas. China, about 60% of their power stack is coal, and they consume close to half of the world's coal production. India is about 73% of their power stack coal. Imagine if just a portion of that switched to gas, how much carbon emissions that would save. And the U.S. is a prime example where their CO2 emissions are down 17% since 2007, despite massive growth in oil and gas production, despite growth in GDP, and it's from the coal to gas switching. So I think it's a proof of concept, and I think that's a near-term option while we invest in the cleaner energy, right? So I think I still, there's increasing pushback about the term, bridge fuel. I think it's going to play a role. It has to fill those intermittent gaps. So that's my thoughts on that subject.
I just weigh in as well that gas, obviously there's the carbon component that you mentioned, but there's also a lot of benefits related to particulates, mercury, sulfur, and so on down the line. So I think there is a sort of local air quality component that may be a driver, particularly if you think about China and that kind of thing. So Patricio, let's bring you into the conversation. You look after some of the gas outlook for Europe, and what's your sense on kind of what the demand trajectory looks like? Because I get the sense that Talon's got this 11% CAGR for U.S. LNG supply. Does Europe need U.S. LNG? And what's going on with the general sort of supply demand fundamentals over there right now?
So yeah, I think the trajectory here for gas demand in Europe may have peaked early on in the 2000s, around 2005 or 2006. Just to frame that, we had demand here was about 420 BCM on 2021, which was close to a 10-year record. That was post-pandemic. And since then, demand has fallen to around 360 BCM. That was 2023. We think there's very little scope for that to recover materially this year, or further into 2030, really. So from that front, it seems like the energy saving measures that the regulators have imposed and have pushed for are working. And that comes coupled with higher renewable power penetration and more electrification of energy demand in general. So I'd echo Talon's view that perhaps, of course, that doesn't necessarily mirror what's going on in emerging nations. And gas is still sort of the lowest hanging fruit in terms of as an option for decarbonization, for sure. Yeah, so looking into the fundamentals for this summer, so European gas prices are at around 25 euros per megawatt hour, which is basically back to the long-term average for European gas prices. That's the first time since the crisis that we are stable at 20 to 25 euros per megawatt hour. What's interesting to see is that European gas storage is at an all-time record for this time of the year. Which means that actually the trend means that the reinjection season is beginning early this year. The gas storage operators in Germany have already indicated that they're going to start injecting gas by the end of this month. So the fundamentals for gas prices in Europe for this summer and possibly next winter are fairly poor, I would say. And in terms of the stranded asset risk, we haven't sort of nailed down the numbers, I'd say, for the regasification terminals built in Europe, but it does seem like the fundamentals have deteriorated for the long-term trend in gas demand. It seems like we won't return to the 2021 levels even, and I'd say it's safe to say that European gas demand has peaked. All that said, there is room for US LNG in Europe. Obviously, there's a geopolitical motivations that perhaps the West will try and favor or strengthen the ties with friendlier suppliers, and the U.S. is certainly that for most of Western Europe. There are still some flows from Russia flowing into Western Europe. It's not a lot. There's still a bit of LNG as well, which combined represents close to 8 to 10% of the supply mix. I don't think regulators or policymakers will be in a hurry to sanction those or to try and halt those. And perhaps there is some incremental growth within that decline, if that makes sense. Some incremental growth in the share of LNG, especially from the US.
Okay, thank you, Patricio. I always get mesmerized when I look at the differential between European gas prices and US gas prices. Just looking at the screen today, you quoted euros per megawatt hour, but we'll put it in dollars per MMBTU. Europe's at sub 8, so 780 something and change. US is at $1.69 per MMBTU right now. So massive differential. And so, Talon, I want to come to you. My sense is that most of the LNG names are sort of perhaps commodity price agnostic, but maybe that's not quite right. So is that differential good for the folks participating in the US export bonanza that's been unfolding?
So for the most part, US LNG is backed by long-term contract, and they kind of pass that commodity risk on, right? Many of them are tolling operators, so they just get paid the liquefaction fee. The way Cheniere, for example, operates, they most of their contracts are Henry Hub plus a premium to cover some of the pipeline and liquefaction costs, and then they get that liquefaction fee, as they call it, to lock in a margin and cover some of the capital costs. Now, as Cheniere built out, they hugely benefited since 2021 and everything that happened with Russia and Ukraine. They benefited immensely in their short-term and spot exposure and really captured those margins. So their EBITDA fell a lot last year, despite it's still extremely elevated. It's going to fall again this year, even though it's still going to be above average, right? This year, they have just far less exposure to the spot market, but yes, as a whole, they pass that commodity risk on. But excuse me, you think about price levels, and there is a sweet spot. I mean, yes, they benefited when the prices were high, but in the long term, that's not positive for them, right? Because it stuns demand, and we've seen recently with prices come down. It kind of spurred demand in more of those price-sensitive nations. And with a lot of supply coming on in the next couple of years, prices will come down. And with those long-term contracts, they have their margins secured, and hopefully it spurs more demand for them, and continues to be a driver throughout the decade, right? Because there is so much supply starting at the end of this year and through 28, 29 between the U.S. and Qatar. Should keep some pressure on prices, and I think it'll spur some demand there.
Quick follow-up. What share, or roughly, give me a sense of how much LNG goes on spot versus long-term contract? I mean, it seems kind of an important variable there.
I think a good rule of thumb is about 90% long-term contract. And one point to mention with the U.S. The U.S. is different from other countries, right? In the sense that despite their long-term contracts, some of it is still considered spot trading because a lot of the aggregators and portfolio players, big oil, are buying the oil, or the LNG from the U.S. and shipping it to the highest bidder, which is why Europe was able to get so much U.S. LNG 21 through 23.
Okay, very interesting. All right, so I want to pivot a little bit away from the sort of broad commodity discussion and just focus in a little bit on some of the company coverage. So for anyone who doesn't know, BI covers over 2,000 equities globally, and every analyst within the team has some segment of companies that they look after. So Talon, we haven't had you on in a little while, and I think most of your companies have probably gotten through their 4Q full year results. Give us a sense what you heard and how you, based on the kind of closeout for 2023, what you think 2024 looks like.
Yeah, so in the midstream and energy infrastructure space, there's a good amount of cash flow and revenue visibility, right? Because of all the long-term contracts, the fee-based earnings. You know, 4Q, kind of, there wasn't too many outliers, and since the pandemic, guidance has gotten pretty conservative. So there was quite a few EBITDA beats in the space. And the outlook for this year, I mean, you know, again, midstream is a lower growth space. But there's been some consolidation. So EBITDA on average may grow mid-single digits, 5-6%. A lot of it is driven inorganically from acquisitions, but there also have been quite a few investments in new projects. A lot of these companies, especially those in the Permian, the gas processing, NGL space, there's been a lot of investment in gas processing plants and NGL fractionators. So you know, they put that CapEx in over the last couple of years. These projects started to come online. There's more coming online this year, and they're, you know, reaping the benefits from that of the throughput. So, you know, some of the growth is inorganic, some of it is organic. And again, it's an income space. Dividend increases keep coming. I believe it was 4% on average last year, something similar this year, which is a nice trend to see. Yeah, so that's kind of what we're looking at. In terms of the outlook, it's clouded a little bit because of, you know, you mentioned a few minutes ago how low natural gas prices are. And we've seen some E&Ps pull back some production plans. But as a whole, oil prices remain conducive to drilling. So in places like the Bakken and the Permian, we'll see that. And then there's associated gas and resulting NGLs from that. And with the midstream space, you still, like I said, the fee-based earnings, there's minimum volume commitments. So those with more exposure to the dry gas basins may be affected. But as a whole, you know, pretty steady year, decent, you know, the dividend increases, decent EBITDA growth, stronger free cash flow. That's where it stands. You know, the 2024 outlook seems okay, despite quite a few headwinds.
Okay, very interesting. Salih, I want to come around to you and chat about Saudi Aramco. They reported over the weekend, and give a sense. Were you surprised by what we heard, and what do you think 2024 looks like?
So yeah, I mean, Aramco reported last Sunday. So I mean, as expected, their net profit fell from a very extraordinary 2022. So just to give you some numbers, the 2023 net income was at $121 billion. This is the second highest bottom line for the company, the highest being 2022, which was at $161 billion net income. But I think the main point, and I think the most interesting bit, was how they are actually increasing their dividends. They have a base dividend and they have a performance-linked dividend, and they're raising both of them for 2024. So they're raising the total dividend payments from about $98 billion paid in 2023 to an expected $124 billion in 2024. So even though net profit is falling, they are committing to dividend payouts, the majority of which obviously is going to the state, which remains the biggest shareholder. But nonetheless, our calculations suggest that if they do pay the $124 billion, that indicates a dividend yield of about 6%, which actually, interestingly, takes them to the highest of the peer group of the super majors globally. So for a very long time, the argument perhaps against Aramco is that, you know, their yield is just too low when you compare it to the global peers. This will actually take them to the top of the peer group, which is interesting. But one thing to mention, because earlier on it was one of the survey questions, and I did mention about their decision, and more a directive than a decision from the kingdom for them to halt their plans to expand their oil production capacity from 12 million barrels per day to 13 million barrels per day. And we've written on this previously, we talked about it on this call. But what we argued about this was that this would obviously lead to lower capex guidance. It would give them the flexibility to pay more dividends. So as I mentioned, they are going to pay more dividends. But surprisingly, their capex levels are not actually coming down. So their capex guidance for this year is in the range of $48 to $58 billion, which is more than the $48 to $52 billion range that we had for last year. So, you know, they are halting that project of oil expansion, but they're not necessarily lowering their capex. And I think what this is signaling is it may not necessarily be going to that big project of expanding their oil capacity, but rather it's probably going to be redirected into some of the incremental oil projects that they had in their pipeline. But also, we know that they've been looking at some potential M&A in downstream. We know they're looking into liquids to chemicals, especially in Asia. But also, I mean, you've been talking about gas quite a bit on the call. They are taking natural gas a lot more seriously. They've said that they're looking at some LNG projects in the US. They're looking for some partners there. And domestically as well, they want to increase their production of non-associated gas domestically so that they can use that more locally and free up more crude oil for exports. So those were the interesting bits those are the bits that we thought were interesting from their 4Q and 2023 results.
One follow-up question. I think I saw that the Saudi government is transferring more of the shares into the sovereign wealth fund for Aramco. And I want to get a sense, just a quick check-in from you. Is that potentially going to ultimately increase some of the liquidity around the shares, put more of it into free float? How do you, does that have any meaning for you, and in terms of how you think about the name?
Not really, not as much as their plans to have another offering. I mean, obviously that would bring a lot more liquidity than kind of moving that stake from the state into PIF. But yeah, I mean, PIF has essentially doubled their stake in Aramco, which means, I mean, they will be fetching close to $20 billion in dividends this year from Aramco, which is quite significant. But in terms of liquidity and what this means for perhaps foreign investors and the minority shareholders, I don't think it means as much as a potential additional share offering.
Okay, very interesting. Okay, Pat, let's swing around to you with a little bit of remaining time. I've got two ideas on my mind that I want to try to get out from you before we conclude. One, let's just do a quick check-in on earnings from your space. I think you had Eon out today.
That's right. So yeah, Eon reported very strong earnings for 2023, and they also increased their outlook for 2024 and also increased their capital budget through 2028, improved the earnings profile overall for underlying earnings, which is it is fairly impressive considering the constrained leverage headroom that utilities usually tend to have, and considering that 2022 and 2023 were record earnings years, and this company is basically offering to build 1% to 2% on top of those record earnings through 2028, which again just talks to the defensive stance of these type of companies, which are basically tied to Europe's energy transition. These companies are regulated, they get reimbursed for all the investments they make, they are insulated from inflation, and there was also some supportive regulatory developments. Their allowed rates were increased, and there's some potential upside there in Germany as well that could become a catalyst for the first half of the year. Maybe they'll be able to get even more returns for their existing assets. Now, why does that matter? Why do I want to tie this into my space? Is that utilities in Europe have been battered from the valuation front this year. The whole sector is down about 7%, and that's mainly because of two reasons. One has to do with gas. So gas prices have come down quite a bit since the beginning of the year. And since gas prices still set the wholesale power prices, that means that a lot of the independent power producers that made record profits in 2022 are seeing their earnings prospects heavily hurt for 2024, 2025. And we think even worse so for 2026 as those hedges roll off. And on the flip side, our thesis has been that perhaps it is the year for the dividends, for dividend payouts and for regulated utilities. Rounding it out, we've seen Italgas report yesterday also increase the profit outlook for the midterm. They also have good capacity to increase their payouts. We have Iberdrola's Capital Markets Day next week, where we do expect also some recalibration of the payout profile for them, just to increase their appeal amid a period of higher for longer rates. And well, that rounds out sort of the landscape for us. We think for utilities, this is the year where dividend payers will be buoyed or lifted, whilst power generators will be hurt by this decline in power prices. Though we note that the main differentiator will be the scope to boost renewable capacity. We do note that gas prices cannot remain this low for too long, and power prices cannot remain this low for too long, just because the policy in Europe doesn't coincide with the near-term slump in power prices, because the main theme remains electrification, and electrification demands better price signals and investment signals to drive Europe's climate goals over the long run.
Patricio, it's not Europe related, but it is a European company. So Ørsted had a big announcement related to offshore wind. You've got a note out on it from just yesterday, I believe. So tell us what happened there and how you're seeing that.
Yeah, so for Ørsted had pulled back from two large projects offshore in the US, and that materialized into heavy exit fees that created a gap in its funding structure, which terminated in the revamp of the strategy or a recovery plan. That plan saw their 2030 ambition for offshore wind reduced by almost a third. And so I think that the worst is over for Ørsted from that front. I think the market wants to regain confidence in the stock, and I think the new plan, which is it is a bit more moderated. It's still credible. The company still aims to double their offshore capacity, and the auction in New York, last 2 weeks ago, was a positive signal that policy support is still there. It is intact. They rebid for a project that they passed on last year. So they were meant to reach a final investment decision last year on Sunrise Wind, and they decided to pass on it in order to rebid this year. That was part of the recovery plan, and they were successful in getting an award at power prices that were significantly higher than what they were in 2023. So that's roughly $150 per megawatt, which is more than 70% higher than the last offtake price. And while offshore wind is still a challenging sector, we think, just because of building the operational scale and supply chains will take time, it is a good signal that policymakers have that resolve of protecting or building that space for offshore wind over the long run.
Certainly some very high energy or electricity prices being agreed to there. There's good read across for Vestas and some of the other wind equipment OEMs. And let me just draw your attention quickly to a note that I put out on another corner of the clean energy franchise, and that's solar plus battery storage. Batteries are becoming a big deal if you haven't been paying attention, and Sunrun, one of the developers in the US, had a battery attach rate of 45% in 4Q. We've seen the attach rates rising across the developer space. So Sunrun, Sonova, SunPower, these kinds of names are increasingly not just selling solar panel systems, but also selling the full solar plus home storage system. And we think there's an important way to think about this for these companies. Consensus, we believe, is kind of not quite keyed in on that rapid rise in battery attach rates. And when you install a battery alongside your solar panels, you're boosting the cost of the system something like 50%. So there's a strong top line growth story that you can infer from having higher battery attach rates. So check out our note. I think it's a pretty interesting piece of work, if I don't say so myself. So anyway, we'll follow up with the email that include the links to some of the research we've been talking about. Just a quick bit of marketing. Next week, Mike McGlone is going to join us, and we're going to have Patricio on again. We're going to talk sort of global commodity macro a little bit with that conversation. Next week, Salih Yilmaz and Will Hares and Hinik Fong, colleague over in Asia, are going to be on a marketing trip. I know that we got an event in Singapore and perhaps a few other places, so reach out if you want to join that conversation. And then just lastly, at the beginning of April, myself, Vince Piazza, who joins this call pretty regularly, plus Brett Gibbs, Jason Miner, a number of other BI colleagues, Mike McGlone as well, will be in Kansas City for a big in-person event. If it is at all of interest, reach out to any one of us. We'll get you the details on any of those events and hope to see you in person. And with that, we'll close it out. And thank you for your time today, and I hope you have a great rest of your week. Take care, everyone.